I'm here today to answer another burning accounting question. Today, while I was talking about net income in an accounting class, one of my students asked me if net income and net worth mean the same thing. It's a great question, and obviously, he's brilliant for asking it. Welcome to Accounting How To. I'm your host, Carolyn Grimm, and that's my sidekick, Terrence the High Net Worth Tyrannosaurus. Seriously, the guy is quite the high roller. Let's get right to answering the question. What's the difference between net income and net worth? A short accounting lesson first. So a business has net income, also known as profit, when its revenues, what we sell to our customers, are higher than our expenses, the costs that we incur to make those revenues. For example, we sell $10,000 worth of merchandise to our customers, and it cost us $6,000 to buy the goods, pay our employees, pay the light bill. So we take our revenue of $10,000 minus our expenses of $6,000, and that gives us net income of $4,000. Net worth, on the other hand, is all about what a business or a person owns and what that business or person owes. So, what a business owns is called an asset, and an asset would include items like cash, vehicles, investments, houses, or buildings. And what a business or person owes is called a liability. And a liability includes items like accounts payable, credit card debt, car loans, mortgages. When you take everything you own, your assets, and you subtract everything you owe, your liabilities, that gives you net worth. Let's look at an example. Let's say you own a house that's worth $250,000. You own a car that's worth $25,000, and you have $5,000 in cash. When you add all those assets together, you end up with $280,000. So that is the value of your assets. Now, let's say that you have a mortgage on that house of $250,000 and you've got a car loan on your car of $10,000. So you have liabilities totaling $260,000. That is the amount that you owe on those assets. When you take your assets of $280,000 and you subtract your liabilities of $260,000, that means that your net worth is $20,000. Now, if your liabilities, what you owe, is higher than the value of your assets, what you own, you have what's called negative net worth. You'll sometimes hear this referred to as being upside down on your loan. What you owe is more than what your asset is worth. Nobody wants to be there. Bad place to be. It's the difference between what you own and what you owe on what you own, if that makes sense. So if you have an accounting question you'd like to have answered, drop it in the comments below. Until next time, stay balanced, my friends.